There we go. A little bit of confusion this morning, but we are live. Or am I? There we go. I am. Now I'm happy. Okay. Picking up where we left off yesterday, section 112016. Income from hydrogen storage carbon capture added to qualifying income of certain publicly traded partnerships treated as corporations. Now, guys, if you're on TikTok or Instagram, you're missing a lot. You're going to want to go to youtube.com/Kellerman Comedy. What's up, Black Sheep? Welcome to the stream. Welcome to the chat. I'm sorry for all the confusion because I don't know how any of this stuff works, and I've been figuring it out by myself. Today we had a little snafu because I tried to schedule the stream so that you could go to YouTube and see it and then start watching like before I started. And then once I actually tried to start the stream, it started a separate stream instead of streaming to that thing I had set up. So, you know, I really thought I was doing everybody a big service by setting it up ahead of time. And in the end, I just ended up fucking myself. So what have we learned? Don't go out of your way to try to make it easier for people. Okay, anyways, where were we? Let's just move this over just a hair here. There we go. So, under the current law, publicly traded partnership rules allow certain enterprises to be treated as partnerships for tax purposes, but also have interests that are regularly traded on established securities markets or are readily tradable on a secondary market. To qualify for this treatment, 90% of gross income must come from qualifying income sources. One of those sources is the income and gains derived from exploration, development, mining, or production, processing, refining, transportation, or the marketing of any mineral or natural resources, industrial source carbon dioxide, or the transportation or storage of specified fuels. This provision expands the activities that can be categorized as qualifying income to include the transportation or storage of liquefied nitrogen or compressed hydrogen and the generation of electricity or capture of carbon dioxide at a direct air capture or carbon capture facility. So basically, we're just expanding a law that already existed for hydrogen storage and carbon capture to include liquefied hydrogen and the generation of electricity. So that's just sort of expanding it to other parts of this industry, just in case. Hi, Lil Bray. Big Daddy Newsman. That's me. I'm just going to double check with AI to make sure I understood that correctly, even though I think I got it here. It's really just adding the transportation or storage of liquefied hydrogen to this category. But just in case I'm misunderstanding something, which is always possible, let's just verify my understanding with ChatGPT. So normally big companies that are traded on the stock market are taxed like corporations, meaning they pay corporate income tax and their shareholders pay tax on profits. But some of these companies are allowed to be taxed like partnerships, which means they don't pay corporate tax. Their profits go straight to the investors who pay taxes once. This is a major tax break. To get this special treatment, they have to be in a business where 90% of their income comes from things like oil, gas, coal, mining, pipeline transport, carbon capture, storing fuel. So what the new provision changes is that now we're going to let hydrogen companies count in there too. So businesses that transport or store hydrogen, especially compressed or liquefied hydrogen, can get this special tax deal as well, meaning more tax savings. So who benefits the most is hydrogen and energy companies, investors in hydrogen projects, or clean energy advocates. These are all the people who benefit. Who might lose? The federal tax revenue. More companies using the partnership loophole means less tax money collected. And non-hydrogen competitors, fossil fuel companies already had this perk. Now hydrogen joins the party. Right? So that's fine. Yes, that does help larger businesses, but it's just including hydrogen-related businesses to the category that already existed. Not really much of a change. It certainly doesn't negatively impact the middle class in helping the wealthy. Section 112017, limitation of amortization of certain... we learned that word earlier in an earlier episode. Limitation on amortization of certain sports franchises. So under the current law, when a taxpayer acquires intangible assets held in connection with a trade or business, the adjusted basis of an amortizable, I believe is how you would pronounce that, Section 197 intangible, can be amortized. We learned what it meant, but we didn't learn how to pronounce it. May be amortized on a straight line basis over 15 years. Such intangibles include goodwill, franchise value, employment contracts, and several other items. So this provision limits amortization deductions for certain sports-related intangibles. Specifically under this provision, a taxpayer that acquires a specified sport franchise intangible would only be permitted under IRC Section 197 to amortize 50% of the adjusted basis. A specified sport franchise intangible is any or amortizable Section 197 intangible, which 1 is a franchise to engage in professional football, basketball, baseball, hockey, soccer, or other professional sport, or 2 is acquired in connection with such a franchise. This change would apply to property acquired after the date of enactment. So this seems, we're on page 36. This seems to be a recent 1,000-page bill. The government has not fully passed this. It was passed by the House. They're saying in the comments, they're discussing what this is. We're 36 out of 50 pages. This is the 50-page version of the 1,000-page One Big Beautiful Bill Act. And the 50-page version is just supposed to be like a summary of everything. And we're on 36 of 50. And we're just going through it line by line. It's been passed by the House, but it has not been passed by the Senate. So it still has a couple of more hoops to jump through. The Senate will likely make changes if they are to pass it. But we shall see. Where was I? Oh yeah, let's just check my understanding here. So this seems to only impact people who own sports franchises. So this may only apply to the wealthy. Black Sheep thinks it's going to pass. I also think it's going to pass, but I think that they're going to make changes. Tell me if you think they're going to make changes to this before they pass it, or if you think it'll just pass. Elon came out pretty strongly recently against the bill. But as we talked about yesterday, it does sort of, I don't want to say negatively impacts EV companies such as Tesla. But it does remove a lot of their tax breaks and things of that nature. It removes a lot of the incentives that people were being given to go electric. So let's say you buy a business. Part of what you're buying might be stuff you can't touch, like goodwill, the company's reputation, brand value, franchise rights, contracts with employees or celebrities. These are called intangibles. Right now you can write off or amortize the cost of those over 15 years, which helps lower your taxes a little each year. So what's changing? If you're buying a sports team, like an NFL, NBA, or MLB franchise, so this doesn't apply to most of us, the new rule says you can only write off 50% of those intangibles, so your tax break is cut in half. This only applies to sports-related stuff, like the right to own the team, the team's name, and the contracts that they come with. So who benefits most is U.S. taxpayers in general. The government collects more tax money instead of giving rich team owners big write-offs. Small business owners, this does not apply to them. They can still amortize 100% of intangibles. It levels the playing field a little bit. So this is specific to rich people who own sports teams will get less of a deduction on their taxes. Hey Liz, welcome to the live stream. I'm so glad you made it. So who loses the most? Billionaires or corporations buying sports teams? They lose half of their tax break. Sports franchises as investment vehicles may be slightly less attractive to buy since they're now less tax efficient. So if you buy a sports team, this is the simple breakdown. If you buy a sports team, you used to be able to write off all of the invisible stuff like brand name, etc. over 15 years. Now you can only write off half of it, so your tax savings are smaller. Team buyers lose, the IRS wins. This does not. This is a tax on the wealthy. Just plain and simple, right? Moving on, we're on page 37 now. Section 112018, limitation on individual deductions for certain state and local taxes, etc. Current law. So under the current law, in the case of an individual, the itemized deduction for state and local taxes is capped at $10,000. That's $5,000 for a married taxpayer filing a separate return. This is the SALT cap you may have heard about. In general, income taxes paid or accrued in carrying on a trade or business or an income-producing activity are subject to the SALT cap. The SALT cap is set to expire for taxable years beginning after December 31st, 2025. All right? So this provision would increase the SALT cap to $30,000, $15,000 for married taxpayers filing a separate return. In the case of a taxpayer with modified adjusted gross income over $400,000, the cap would phase down by 20% of the excess of MAGI, which is modified adjusted gross income. This provision would extend the SALT cap permanently for taxpayers for taxable years beginning after this year, 2025. This provision also includes several changes to prevent the avoidance of the SALT cap. Generally, this provision clarifies and modifies the list of taxes subject to the SALT cap, specified taxes, provides that certain payments that substitute for specific taxes are also subject to the SALT cap, requires partnerships and S corporations to treat specified taxes as separately stated items, imposes an addition to tax in certain cases where a partnership makes a state or local tax payment, one or more partners receives a state or local tax benefit, and the allocation of the tax payment differs from the allocation of the tax benefit, prevents the capitalization of specified taxes, and grants the Secretary of Treasury regulatory authority to prevent avoidance of the SALT cap. So I guess people have been avoiding this SALT cap, and now they're going to make it harder to do that. But is avoiding the SALT cap good for everybody? Let's ask AI. Correct. Liz says normal Americans are not buying sports teams. This is basically a tax on the rich, which is true. All right. So what's the SALT cap? When you do your taxes, you can choose to itemize and deduct state and local taxes you paid, like state income tax, property tax, sales tax, but there's a limit on how much of those taxes you can deduct. Right now it's $10,000 or $5,000 if you're married and filing separately. This cap will hurt people in high tax states like New York, California, New Jersey, etc., who pay a lot in state local taxes. The cap is set to go away after 2025 unless Congress does something. So the new provision raises the cap to $30,000, but if you make over $400,000, your cap goes back down as your income goes up until it's back to $10,000 again. It makes the cap permanent instead of letting it expire in 2025, and it closes some tax loopholes rich people and partnerships use to dodge the cap through tricky state-level workarounds. So who benefits the most? Middle and upper-class income people in high-tax states. If you pay $15,000 to $30,000 in property or state income taxes, now you can deduct more of it, lowering your tax bill. So, yeah, dual-income households, they get the full benefit of the higher cap. High-tax states, So that's dual income households making a combined total of less than $400,000. And high tax state governments benefit the most because it's easier to defend their tax system when residents can deduct more on federal taxes. Who loses the most? High income earners over $400,000. Their cap shrinks back down to $10,000, so they don't get as much benefit. People using workarounds as partnerships, S corps, etc. The IRS is now cracking down on tricks to dodge the cap. And taxpayers expecting the cap to expire in 2026. The cap is now permanent, so no full SALT deductions ever again unless it's changed in the future. The too long didn't read is, right now you can only deduct $10,000 in state or local taxes in your federal return. This raises the cap to $30,000 for most people, but not for the rich, people who make over $400,000. It also blocks tricks people were using to get around that cap. So the winners are middle and upper class middle earners or high tax states, and the losers are rich people and tax dodgers. So, once again, this provision, section 112018, good for the middle class, bad for the wealthy. Not bad for the wealthy, just basically nothing changes for the wealthy. If you don't make $400,000, Liz, then this applies to you. This raises the amount that you can deduct. You may not have that much to deduct, obviously, but it is specifically for people who earn or make less than $400 a year, which excludes the wealthy. Okay, section 112019. Excessive employee remuneration from controlled group members and allocation of deductions. So under the current law, publicly held corporations are denied a tax deduction for compensation paid to certain covered employees, typically the CEO, CFO, and the next three highest paid officers, exceeding $1 million a year. The Tax Cuts and Jobs Act expanded the scope by eliminating the performance-based compensation exception and including more entities like certain publicly traded partnerships as covered corporations. The limitation also applies to taxable years beginning after December 31st, 2017. ARPA expanded the definition of, that's ARPA, expanded the definition of covered employees to include the five highest compensated employees beyond the CEO, CFO, and three highest paid officers, effective for tax years beginning at the end of 2026. Unlike the original covered employees, these additional five are not subject to the once covered, always covered rule and are determined annually based on deductible compensation. This provision applies aggregation rules This provision applies aggregation rules for the Where's my coffee? Where's my goddamn coffee? That's what's missing. That's why I'm not reading right. This provision applies aggregation rules for the purposes of the deduction, limitation, and allocation of deduction applied under IRC section 162M as it relates to certain excessive employee. This says remuneration, but it definitely is meant to say remuneration, the way it does up here. Remuneration? Remuneration. Okay. And then here's the remuneration down here. Okay, so this has to do with how top people at organizations get bonuses. So under the current law, if you're a publicly traded company, you can't deduct more than $1 million per year in pay for certain top employees. And starting in 2027, it also includes the next five highest paid. That means paying huge salary costs more because you don't get a tax break on it. This rule was created to discourage massive executive pay and make companies think twice before handing out huge compensation packages, right? The new provision says you can't get around the 1 million limitation by splitting your company into pieces or hiding big pay through technical loopholes. So now, companies that are connected or part of the same group will be treated as one company. This eliminates a loophole that the rich were using. The $1 million limit applies across the whole group, not just individual entities, and also prevents shady allocation tricks where companies try to claim more deductions than allowed by splitting the pay across different subsidiaries or departments. So who benefits the most? U.S. taxpayers, federal government, more taxes collected because companies can't deduct as much high-end executive pay, and shareholder advocacy groups because it helps rein in excessive CEO pay and promote pay fairness. Who loses the most? Public corporations and complex structures can't use subsidiaries or loopholes to get around the $1 million pay deduction limit anymore because it's a limit. Highly paid executives lose because their companies have less tax incentive to keep giving them huge raises and bonuses. And tax planners and lawyers, fewer tricks available to minimize taxes on massive pay packages. So basically the winners are taxpayers and reformers, and the losers are companies with high paid execs and complicated structures trying to sneak around this cap. Once again, this seems to benefit the lower income more than the higher income. Right? Lil Bray says this bill is a dub, but I don't know what that means. A dub? A duplicate? A double? A W? All right, section 112020, expanding application of tax on excess compensation within tax-exempt organizations. Under the current law, IRC section 4960 imposes an excise tax on excess compensation paid to certain highly compensated employees by applicable tax-exempt organizations. The excise tax rate is equal to the corporate tax rate multiplied by the sum of again, this says remuneration, but I'm pretty sure that means any remuneration in excess of $1 million paid to a covered employee for a taxable year, and 2, any excess parachute payment paid to a covered employee. This provision strikes the text following means any employee, including any former employee of an applicable tax-exempt organization, from the definition of covered employee under IRC section 4960C2. As a result, a covered employee includes any employee of an applicable tax-exempt organization that receives remuneration in excess of $1 million. Hold on, we have to look up remuneration now. Was it misspelled in earlier, or is it constantly being misspelled here? Okay, so it was misspelled the first time, not the next 3 times. Remuneration is the pay or other financial compensation provided in exchange for an employee's services performed. So it's their pay. Why would you call it remuneration? I mean, remuneration is also a word, though. Right? No. It was misspelled the first time. There is no remuneration. Only remuneration. Dub is a win-win. Got it. Thanks, Nick. Nick says, I think there is less for lower middle class, more for business rich. I'm not sure exactly what you're referring to, but nothing I've read today has benefited the wealthy more than the non-wealthy, except for people who own the sports leagues, I guess. The Welcome to Wrexham guys are going to get less of a tax break. Okay, moving on. Section 112021. And if you're watching on TikTok or Instagram, you're probably going to have a better experience on youtube.com/Kellerman Comedy. Just taking a look at the comments here. Brendan A. O'Keefe says, I want more remuneration. Yeah, wouldn't we all? We'd all like a little more remuneration. And then on Instagram, people are saying nothing interesting. 100 pounds. Join the tube side, says Liz. Come on over to youtube.com/Kellerman Kellerman commenting. And if you're already on YouTube, thanks for joining. We are now on page 38, section 112021. You know, Black Sheep, if you wanted to, you could go over to the Instagram and TikTok lives and just tell everybody what's going on. But, you know, you're doing such a good job here on YouTube, I don't want to give you any more work. I really appreciate you. Modification of excise tax on investment income of certain private colleges and universities. The current law states that IRC section 4968 imposes an excise tax on an applicable educational institution for each taxable year equal to 1.4% of the net investment income of the institution for the taxable year. Provision. All right, so this provision amends the current excise tax on net investment income framework for certain private colleges and universities under IRC section 4968 with a tiered system based on an institution's student-adjusted endowment. See table below. This is the table that it is discussing right here. Okay, for purposes of calculating an institution's student-adjusted endowment, this section amends such calculation by excluding students who do not meet the requirements under section 484A5 of the Higher Education Act of 1965. Let's just see what that is. Let's just take a look at that section of the Higher Education Act. Thanks, Lil Bray. I love you too, bro. Or lady. I don't know what your gender is, and I'm sorry if I misgendered you. Section 484A5 of the Higher Education Act of 1965, codified at 20 U.S. Code 1091A5, pertains to the eligibility criteria of students seeking federal financial aid. Specifically, it requires that a student must be a U.S. citizen or national or an eligible non-citizen to qualify for federal grants, loans, or work-study programs. This provision ensures that federal financial assistance is directed towards individuals who have a recognized legal status in the United States. This already exists. This is already how it is, guys. Eligible non-citizens typically include lawful permanent residents, green card holders, refugees, asylees, and certain other categories of immigrants as defined by the Department of Education. Therefore, under Section 484A5, students must meet specific citizenship or immigration status requirements to access federal student financial aid programs. This is going to affect that. I believe this changes some of the requirements. Let's just have AI explain it like we're stupid. So under the current law, if a rich private college or university has a big investment fund, which they call an endowment, it has to pay a small tax on the money it makes from that fund, usually 1.4% of its investment profits each year, and this only applies to very wealthy schools like Harvard, Yale, etc., not regular colleges. What's changing is a new tier system. The tax rate will now depend on how much money the school has per eligible student, so it's the endowment divided by number of students. Richer schools could pay more, and slightly less rich ones might pay less. So in theory, that sounds good, but there's some maybes and mights in there also. Some students don't count. When calculating how rich a school is per student, it will now exclude students who aren't U.S. citizens or eligible immigrants, based on a rule called Section 484A5, which we just read together. So a school with lots of international students may look richer per student and pay more taxes. Religious schools can be exempt. Certain religious colleges that meet special criteria won't have to pay this tax. More income is taxed. Now schools also have to include student loan interest income and some royalty income when figuring out how much profit they made from their investments. So who benefits the most from this? Religious colleges that qualify, they may get full exemption from this tax. Middle-tier private schools could end up paying less under the new tiered system. And federal government taxpayers, richer schools pay more tax, which equals more revenue collected. So who loses the most is elite private universities with large endowments. They might pay more in taxes. it's their loss, but it's our or the government's gain, right? Colleges earning money from student loans or royalties. Now that income counts towards their taxable amount. The too long didn't read is rich colleges pay a tax on investment profits. Now, really rich ones pay more, especially if they have lots of international students, and religious schools may get out of the tax, or more income sources are now taxable. Is this... I'm asking ChatGPT if this is good for the many or the few. This change is mostly good for the many, and here's why. Wealthy colleges will pay more, so the law targets a very small group of elite private universities with massive endowments. These schools often have billions of dollars, yet pay little to no taxes because they're colleges. And by taxing them more fairly, the government can raise money for public services, financial aid, and education programs that benefit the broader public. More fairness across schools. Smaller private colleges and middle-tier schools pay less or nothing at all. Religious institutions that meet certain rules are protected, and it rewards schools that serve more U.S. citizens or eligible residents than immigrants. So who it's not good for? A handful of ultra-wealthy universities with large international populations or complex income streams will lose tax deductions, pay more on investment profits, and have fewer loopholes. So the law is good for the many, especially taxpayers, students at smaller colleges, and the public education system. It only hits a few very rich schools, which can easily afford to pay more. Sounds pretty good. Maybe a good thing for community colleges, says Liz. And Nick says, I love these lives. Thanks, Nick. You should go live every day, Kellerman. Should I? Should I go live? Should I go live more regularly, guys? Tell me what you think in the chat. Moving on to section 112022. Increase the rate of tax on net investment income of certain private foundations. Under the current law, all private foundations that are exempt from taxation under IRC section 501A are subject to an excise tax equal to 1.39% of the net investment income of such foundation for the taxable year. This provision amends the current excise tax on net investment income framework for tax-exempt private foundations under IRC Section 4940A with a tiered system that maintains the current excise tax rate for private foundations with less than $50 million in total assets, but applies higher excise tax rates to private foundations reporting $50 million or more in total assets. See the table below. This is the table. Okay? This again sounds like it's going to benefit the less wealthy to me, but let me check my understanding here. Vintage Hippie says, I could hang with you all day. Thanks. I could do this all day. I'm not going to. But I do enjoy this sort of live back and forth where we're all just doing the work together, right? What is the average American salary every year? It's not $400K. That's true. That's true. And that's why the portion of the bill that we were talking about is best for the people who make less than $400,000 a year. That's a majority of them. That's all of the middle class, I guess. Right? Because if you're making more than $400,000 a year, you're probably not considered middle class. So it only applies, that was a tax break or benefit for people who make less than $400,000 a year. That's good. It's good for us. Unless the person making that comment makes more than $400,000 a year. I think they would agree that that's good. Okay, so AI says if you run a private foundation like a charitable trust set up by a rich person or family and it has investments that make money, in other words, stocks, property, etc., things that grow in value, the foundation has to pay a 1.39 tax on those profits every year, even though it's a nonprofit. This is a small tax just on investment income. So the new rule is saying if your foundation is super rich, you'll pay a higher tax rate than the smaller ones. Specifically, If your foundation has under $50,000 in assets, you keep paying 1.39%, which is the same as it currently stands. But if your foundation has over $50 million, you'll likely pay a higher rate. So who benefits the most is small to mid-sized private foundations, less than $50 million. The tax doesn't go up, they keep the lower rate. The general public taxpayer, richer foundations pay more, which could mean more tax revenue to support public programs. That's not necessarily where the money will go, but it is more tax revenue, right? And charity reform advocates. This helps prevent foundations from just hoarding wealth instead of giving it away. So who's impacted the most is very large private foundations who have over $50 million. They'll pay more in taxes on their investment income. The ultra-wealthy individual families who use foundations to manage their charitable giving, their foundations may become more expensive to maintain, and high-end financial planners, fewer tax advantages equals fewer clients using foundations just to shelter their wealth. So again, this seems to close a loophole. If you run a small private foundation, nothing changes. But if your foundation is really rich, you'll have to pay more in taxes on the investment profits. So winners are the small foundations and taxpayers. Losers are the big foundations and the ultra wealthy using them. Once again, we've got something that seems to benefit the lower and middle class people and not the ultra wealthy. This makes them pay more. Somebody just said you give the news a Daily Show type vibe, but the Daily Show gives the news a Daily Show type vibe. And they're also heavily biased. I like to think that I provide a different sort of service than the Daily Show. I also don't make fun of the news, which I feel like they do. I might laugh at something stupid that a politician says, but I don't make jokes about, all the people who just died in Nigeria. That's not what my show does. I want to make you laugh, but not by making fun of the terrible events going on, Moving on, section 112023. Certain purchases of employee-owned stock disregarded for purposes of foundation taxes on excess building holdings. So under the current law, the combined holdings of private foundations and all of its disqualified persons are limited to 20% of the voting stock in a business enterprise that is a corporation. Holding in excess of the holding percentage are subject to a 10% excise tax, which is increased to 200% if the holdings are not reduced by the end of the taxable year. So this provision amends IRC section 4943 and states that shares of stock repurchased by a company from a retiring employee who participated in the company's employee stock ownership plan are treated as outstanding for purposes of calculating the share of that company owned by a private foundation. It got a little confusing there at the end. I'm going to check my understanding, but what I think I understood is that employees who are retiring and selling their stock that they owned from their stock purchase plan don't incur as much of a tax, or it may actually have something to do more with the company that issues the stock. So under the current law, if a private foundation owns stock in a business, it can't own too much. The foundation and this is specifically to private foundations who own stocks. The foundation and its insiders can own no more than 20% of the voting stock in a company. If they go over, they get hit with a 10% penalty tax, and if they don't fix it by the year end, the tax jumps to 200%. This rule prevents rich people from hiding control of companies inside foundations, which are supposed to be charitable. Under the new rule is about how that 20% is calculated, right? So normally if a company buys back stock, say from a retiring employee, okay, so that's just an example. Normally if a company buys back stock, say from a retiring employee in an employee stock ownership plan, the total number of shares goes down, so the foundation's percentage of ownership goes up, even if it didn't buy more stock. This new provision says that when calculating ownership, will still count those repurchased shares as if they still exist. So this prevents a foundation from accidentally breaking the 20% rule just because someone retired and sold their shares back to the company. So who benefits the most? Private foundations with stock in employee-owned companies. They're less likely to get hit with penalty taxes just because of retirees. And companies with employee stock ownership plans, they can buy back shares from retirees without hurting their non-profit shareholders. Who loses the most is the federal tax, the IRS. Fewer foundations paying penalty taxes, but only in niche cases, right? Foundations trying to push the limits. They can't use stock repurchases as a loophole to artificially stay under the 20% cap. So it's sort of a give and take here, right? I don't know. This seems like a net benefit. Winners are foundations, employee-owned companies. No big losers, just fewer surprise tax bills, right? So this doesn't really negatively impact anybody. And it doesn't really positively impact that many people either. It's niche cases is what it's being called. This probably doesn't, impact too many people. Moving on to section 112024, unrelated business taxable income increased by amount of certain fringe benefit expenses for which deduction is disallowed. What do you guys think? What do you guys think so far? Thanks, Sherlock. Sherlock Sutherland says, I like your style. I'd watch you daily. I appreciate that. I put out something almost every day, so I hope you watch daily. Black Sheep says, I like the non-biased takes. I appreciate that. It's hard to stay neutral, but I think it's important. And there are very few neutral voices, so I'm throwing my voice into the ring. Where were we? Section 112024, unrelated business taxable income increased by amount of certain fringe benefit expenses for which deduction is disallowed. Okay, so under the current law, the amount paid or incurred for any qualified transportation fringe benefit is exempt from unrelated business taxable income. This provision will amend IRC Section 512 to increase the unrelated business taxable income of a tax-exempt organization by including the amount paid or incurred for any qualified transportation fringe benefit. What? I didn't understand that at all. Help me, ChatGPT. Anybody get that one? Anybody understand what that means before I put it into ChatGPT? Danny Brown says, what do you think about World War III possibly starting? And if it does, do you think is wiped out first? I think it probably means US. What do I think about World War III possibly starting? I think people have been claiming that World War III is about to start almost my entire life. And it never has. I think nobody really wants a world war, including the warmongers and fearmongers that run certain countries. They don't really want, even though World War III would be great for some businesses, they don't want to be the leader during a war, you know? I think they have ways of profiting off of war, and being the leader is one of the least ways to profit off of the war. And do I think the U.S. is wiped out first? No, certainly not. The U.S. definitely has one of the strongest militaries in the world, if not absolutely the strongest military in the world. Anyways, where was I? So, under the current law, if a nonprofit organization like a charity, museum, or university gives its employees commuter benefits like free parking, bus or subway passes, bike reimbursement, that money does not count as taxable income for the nonprofit. It's totally tax-free. What's changing is, if a nonprofit pays for these transportation perks, it now has to count them as taxable income. This means that those commuter benefits get taxed under something called unrelated business income tax, a tax nonprofits pay when they do stuff not related to their mission, right? So who benefits the most is the IRS because they're collecting more taxes, and for-profit employers because nonprofits will lose a small tax advantage they had when offering fringe benefits. So yeah, earlier, I believe in an earlier section, they took that benefit, the tax benefit, away for for-profit businesses, and this section takes away the benefit for nonprofit organizations. So they now have to pay tax on benefits like parking or transit passes that they give to their staff, and employees of nonprofits. So some nonprofits may cut back on those transit benefits because, to avoid the new tax cost. So the TLDR is nonprofits used to give free parking or bus passes without paying tax. Now they have to count those perks as taxable income, meaning higher taxes for the organization. Right? So it's not a tax on the employee. It's a tax on the company. And really, it's just the removal of a tax break that they used to get. To be clear, those nonprofits and things could still offer that to its employees. They just don't get a tax break anymore. Section 112025, name and logo royalties treated as unrelated business taxable income. Under the current law, the income from the sale or licensing by an organization of its name or logo is exempt from unrelated business taxable income. This provision amends IRC Section 512 and 513 to increase the unrelated business taxable income of a tax-exempt organization by including the income from any sale or licensing by an organization of its name or logo. So if a nonprofit sells or licenses out its name or logo, that used to not be taxable and now it is. At least that's my understanding. Let's check it. Let's check to see if I understood that correctly. If a nonprofit makes money from selling or licensing its name or logo, it used to be tax-free. Now it's taxable like regular business income. So big brand nonprofits pay more. Nailed it. I got that right on the head. Moving along. Section 112026, exclusion of research income limited to publicly available research. Current law. Under the current law, all income from research performed by a nonprofit organization whose primary purpose is to carry on research that is freely available to the public, including income from private research, is exempt from unrelated business taxable income. This provision amends IRC Section 512 to increase the unrelated business taxable income of a tax-exempt organization by including the income generated from non-public research for an organization whose tax-exempt purpose is to provide publicly available research as unrelated business income. I think that this is just adding something to the unrelated business income. But let's clarify. Andrew is asking what page this is in the 1,000-page version of the bill, and I am actually going to compare the 50-page version to the 1,000-page version at the end of this, after we've completely read through the 50-page version. I want to go line by line in the 50-page version, and then we will compare and contrast what's left out of the 50-page version and if there's any other differences, right? So, under the current law, if a nonprofit research organization, like a university, lab, or think tank, makes money doing research, it's not taxed, as long as the research is meant to be shared with the public. Even if a private company pays for the research, as long as the results are available to everyone, it's considered part of the nonprofit's mission, so no tax. What's changing is that if a nonprofit makes money doing private research that's not shared with the public, that money is now taxable. But that's not a change. So if a research lab is doing a confidential project for a company and keeping the results private, that income gets hit with a business tax. So who benefits is the IRS, for-profit research firms, because nonprofits now pay tax on private contracts, so the playing field is more even, and the general public, because this discourages nonprofits from acting like private contractors while still avoiding taxes. Who loses the most is nonprofits that do private or proprietary research, such as biotech or defense companies. Now they have to pay tax on that income. Universities and research hospitals with corporate partnerships will also lose part of their financial advantages they had for doing contract-based research. But really, it's... So So the winners are the IRS and for-profit firms because it evens the playing field between for-profit and non-profit. And the losers are non-profits making money from private or classified research deals. So to be clear, if... and I'm going to just make sure that I'm understanding this correctly. So if non-profits make money from public research, no change? Right. So if a nonprofit makes money from research that is publicly available, then nothing changes under the new rules. This is only for privately kept data. Okay, if their research is public, nothing changes for them. The research is paid for by a private entity. The new rule only applies when the research is paid for by a private entity and the results are not shared with the public. Public research still tax-free. Private secret research, taxed now, but wasn't before. Again, this seems to add to transparency, which I think is generally good. Thanks, Andrew Price. Yeah, hit that like button, guys. Like the video. Make sure you're subscribed on YouTube and the other places, you know, Substack, TikTok, Instagram, all the places. Also, hit the bell notification button so that you get notified when I go live. I think that's an important part too. Where are we here? This is the bottom. We're gonna finish page 40, and then I'm gonna call it for today. All right, section 112027, limitation on excess business losses of non-corporate taxpayers. Under the current law, in the case of a non-corporate taxpayer for taxable years beginning before January 2029, no deduction is allowed for an excess business loss. An excess business loss is the amount by which the deductions, excluding net operating losses and qualified business income deductions, attributable to trades or businesses of the taxpayer exceed the income from such trades or businesses plus $313,000 for tax years beginning in 2025, and is adjusted for inflation. A disallowed excess business loss is generally treated as a net operating loss and may be carried over and used in another tax year. This provision makes the limitation on excess business losses by non-corporate taxpayers permanent. The provision also provides that excess business losses disallowed in taxable years beginning after December 2024 are taken into account in determining a taxpayer's excess business losses in subsequent taxable years. That was a lot. That was a big mouthful. Cyrus Peck says he's the only person who's liked the video. What's up with that, guys? Give me a thumbs up. Tell me you like what I'm doing. So, in the current law, if you're not a corporation, you're a sole proprietor partnership or LLC, and your business loses a ton of money, you can't deduct unlimited losses on your taxes right away. There's a cap. In 2025, it's $313,000 or $626,000 if filing jointly. If your losses go over that limit, the extra is called excess business loss. That extra loss isn't gone, it just becomes a net operating loss that you can use in future years instead. But this rule was supposed to expire after 2028. What's changing is it doesn't expire. This cap on excess business losses is permanent. Also, if you have leftover losses, those still count against future limits too, so you can't just stack huge losses year after year. Although if you're stacking losses, I don't know if you're in that good of a shape. So who benefits the most, right? Federal government and IRS will collect more taxes from wealthy business owners by limiting their big write-offs. Middle-income business owners are not really affected. Most don't have losses big enough to hit this cap. And people who want fairness. This stops ultra-wealthy people from using paper losses to wipe out taxes indefinitely. Because you could roll it over, right? So if you only have $50,000 to pay in taxes, but you have $1 million in losses, you used to be able to save half of that for next year's $50,000 tax that you were going to have to pay. And now you can't do that. So who loses the most is the very wealthy. Non-corporate business owners. They can't fully deduct large business losses all at once. investors in risky ventures and startups. If their investment loses a lot in 1 year, they get less immediate tax relief, and tax planners fewer tools to offset taxable income with big write-offs. So if your business loses more than $300,000, you're going to have to be a somewhat large business in order to lose $313,000. You can't deduct the whole thing right away. You'll have to spread it out over future years, and this cap was temporary before, but now it's forever. So the winners are IRS, middle-income taxpayers, and fairness advocates. The losers are high-income business owners with big losses. It's asking me if I want an example of how the cap works. And yes, I would like an example. Andrew Price says, so it makes it harder for new businesses to make it. Let's see. Does this make it harder for new businesses in any way? Andrew's right. This rule can make it harder for new businesses, especially those that lose a lot of money in the early years, which is pretty common. So when you're starting out, you often spend a lot on equipment, staff, and marketing and don't make much money at first. So you might have a big loss in year 1 or 2. In the past, you could use that loss to wipe out other income on your taxes or get a big refund if you had other business income. But now, if your loss is too big, that is, if you lose more than $300,000, you're not allowed to deduct it all. Instead, the extra loss becomes a net operating loss that you have to use slowly over future years, so you get less tax relief when you need it the most, which is early on. So yes, it makes starting a business harder because your cash flow is tight. You can't use your full loss to lower taxes or get a refund, so you keep more tax burden early on. Relief is delayed. The money you would have saved this year gets pushed into future years. And riskier startups are discouraged because if your business needs heavy investment and will definitely lose money early on, that's going to limit your safety net and ability to get investment. So yes, this rule makes it harder for new businesses because you can't fully deduct big early losses. You have to wait years to use them, even though you need the help now. But to be clear, you still get tax benefits. You just aren't getting as big of a tax benefit. Moving on to section 112028. 1% floor on deduction of charitable contributions made by corporations. So under the current law, corporate taxpayers are generally allowed a deduction for charitable contributions up to a limitation equal to 10% of their taxable income. This provision establishes a floor equal to 1% of taxable income for the deductibility of corporate charitable contributions. In the case of corporation with charitable contributions exceeding the 10% limit, the provision allows taxpayers to add the amount disallowed under the 1% floor to the amount carried over to the subsequent year. That's a big tax mouthful. I didn't really understand all of that, to be honest with you. Liz is a tattoo artist and people are asking her where her shop is. If you want a tattoo, go see Liz in the comments. What state? Just tell us what state you're in, Liz. You don't be specific about where you actually are. So, under the current law, if a corporation gives money to charity, it can deduct that donation from its taxes up to 10% of its taxable income. The example is, if a company makes $1 million in profit, it can deduct up to $100,000 in donations. Anything beyond that, it can't deduct this year, but it can carry over and use it in future years. What's changing is, you can only start deducting charitable donations after you've made at least 1% profit. So now, the first 1% of your income acts as a floor. You can't deduct anything until donations go over that 1% threshold. But if your donation is blocked by this 1% rule, you're still allowed to carry it forward to use later, just like under the old 10% rule. So basically, you can't deduct the first 1% equal of your charitable donations. But you could carry it over. So if you had 9% the following year, this 1% that you didn't get to take advantage of would carry over to make it 10% the following year. So who benefits the most is the IRS because they're collecting more tax revenue since corporations can't deduct as much each year. Companies that donate a little or strategically, if they give modest amounts, they're likely unaffected. And charitable deduction reform advocates. So this prevents companies from using charity purely for tax breaks. Who loses the most is corporations with very low profits but high donations. Give me an example of that, ChatGPT. Give me an example of a business, of a corporation with very low profits but high donations. Why would you do that? Liz is in Colorado, guys. Oh, I guess she's in Wyoming now. Well, she's moving around, so if you want a tattoo, you're going to have to schedule it with her. Green Goods, Inc. is a small, eco-friendly company. In 2025, it makes $100,000 in taxable profit. Because it believes in giving back, it donates $20,000 to charity. So under the current law, Green Goods could deduct up to 10% of taxable income. 10% of $100,000 would be $10,000. That means $10,000 of their donations is deducted this year, and the remaining $10,000 can be carried forward to future years. They get a big tax break now and carry over the rest. But under the new rule, Green Goods must skip the first 1% of income before it can start deducting. So 1% of $100,000 is $1,000. So only the donations above $1,000 are eligible. That's $19,000 instead of $20,000. But the 10% limit still applies. So this year they can only deduct 10% of $100,000, which is $10,000, and the other $9,000 carries over. But they permanently lose the ability to deduct the first $1,000 due to the new floor. Why this hurts low profit companies? Even though Green Goods is very charitable, it has low profits. The new rule punishes high giving in tight years. Large profitable companies likely won't notice this rule, but smaller, generous ones like Green Goods lose immediate tax relief and may donate less next year. By 1%, guys. 1% it's changing. And as much as I'm for like charitable donating, I feel like if you're a business, you should probably make the money before you donate it. Right? I mean, I love a good, I buy Bombas socks, right? They give a pair of socks to, as charitable contributions every time you buy a pair of socks. They're going to get a little bit less of a tax break. 1% less. 1%. I don't know if that's really that detrimental. Section 112029, enforcement of remedies against unfair foreign taxes. So under the current law, there is no current law. This new provision provides a response to certain unfair taxes, which include both discriminatory and extraterritorial taxes imposed on U.S. persons or certain foreign entities owned by U.S. persons by a foreign government. The provision applies a delayed effective date to allow time for negotiations and provides discretion for the Secretary of the Treasury to expand or narrow the definition of unfair taxes. The provision requires the Secretary of the Treasury to provide a list of unfair taxes to aid withholding agents who are permanently to rely on the published list in determining appropriate withholding rates and are granted relief from penalties and interest with respect to errors until January 2027 if they demonstrate best efforts were made at compliance. The provision responds to unfair taxes by increasing the rate of tax generally applicable to certain taxpayers connected to foreign jurisdiction. Affected taxpayers generally include the foreign government, resident individuals, resident corporations, resident foreign private foundations, and entities owned by such persons. The increases apply to certain income, withholding, and excise taxes imposed on non-residents. The rate of tax imposed increases from the rates otherwise applicable under current law in 5% increments for each year the unfair tax is imposed, until either the unfair tax is removed or the tax reaches a maximum amount equal to the relevant statutory rate plus 20%. That is some legal jargon. That's some legal jargon. The provision who also applies to certain domestic entities that are owned by a tax resident of a foreign jurisdiction that imposes an unfair tax. These domestic entities are subject to certain modifications to the base erosion anti-abuse tax, aka BEAT, that expands the scope of entities subject to the minimum tax, increases the applicable rate, reduces the benefits of certain credits, and expands the taxable base to include certain payments that are currently excluded. Boy, that was a long one. That was a long one. Let's just check my understanding here. So some foreign governments are hitting U.S. businesses and citizens with what the U.S. considers unfair taxes. Andrew Price says, I wonder if that 1% affects that deduction for scholarship donations. I don't think that scholarship donations were involved in that. At least not in any of the things that were used as examples. Discriminatory taxes that only target U.S. companies, extraterritorial taxes, which charging U.S. people for business done outside the foreign country. The U.S. is saying if you tax us unfairly, we'll tax you more in return. So what this provision does, it creates a list of unfair taxes. The Treasury will decide which foreign taxes are unfair and publish a list to help U.S. companies know who's affected. Delays penalties until 2027, so U.S. withholding agents, the people handling taxes on payments, get a grace period to learn and adjust to the new tax breaks. It imposes penalty taxes back. If a country keeps taxing Americans unfairly, the U.S. will raise tax rates on that country's residents, companies, and government-related entities, and U.S. companies owned by those foreign residents. The tax rate goes up 5% per year until it's 20% higher than normal, or until the foreign country stops their unfair taxation. This tightens tax rules on foreign-owned U.S. companies also. If you're a U.S. company owned by someone in a country with an unfair tax, you'll face higher minimum taxes, more payments taxed, and fewer tax credits. So who benefits the most? U.S. taxpayers and companies. This protects them from unfair foreign taxes and raises foreign accountability. The U.S. Treasury, which because it collects more revenue from foreign governments or companies that don't play fair, and withholding agents in U.S. financial institutions are given time and clear rules to avoid accidental penalties, right? So who gets hit the hardest? Foreign governments imposing unfair taxes on the U.S., foreign-owned U.S. companies in bad tax countries, and multinationals with complex cross-border ownership. The too long didn't read is, if a foreign country taxes U.S. businesses unfairly, the U.S. will hit back with higher taxes on that country's people and companies until they stop. Also, U.S. companies owned by people in those countries will face stricter rules and higher taxes. So the winners are U.S. companies and taxpayers. The losers are foreign governments and foreign-linked companies that try to exploit U.S. tax loopholes. Sounds all right. That sounds okay to me. Section 112030, reduction of excise tax on firearms silencers. Under current law, a silencer is defined as a firearm for purposes of the National Firearms Act and is subject to a $200 transfer tax. This provision eliminates the transfer tax on silencers. Am I understanding this correctly? We're talking about eliminating a tax on silencers, which is the little thing you put on the end of a gun to make it silent? That can't be. That can't be what that means. Could it? Right now, a silencer, which is the thing that makes guns quieter, is treated as a firearm in itself. If you want to buy or transfer just a silencer, you have to go through a background check, register it, and pay a $200 tax. The new provision says you can still register a silencer, but you don't have to pay the $200 tax. So silencers are still regulated, but the $200 fee goes away. I think that's okay. Gun owners and buyers can now buy or transfer a silencer without paying an extra $200 in tax. Gun stores and silencer manufacturers have a lower cost, which means more sales for them. And Second Amendment advocates obviously see this as a win for gun rights and deregulation. So the losers are the federal government because they're not making $200 per silencer. Gun control advocates believe this reduces friction for acquiring silencers, which they see as potentially dangerous. And public safety critics who argue that silencers make it harder to detect gunfire and crimes, though evidence is debated. Right? Interesting. I'm not a gun silencer owner, so I wasn't aware that silencers were basically taxed like a firearm. Moving on to section 112030, reduction tax. Oh, that's the one I just read. 112031, modifications to de minimis entry privilege for commercial shipments. Under the current law, section 321 of the Tariff Act of 1930 generally allows shipments bound for American businesses and consumers valued under $800 to enter the U.S. free of duties and taxes. This provision, effective July 1st, 2027, so this is still a full 2 years away, repeals the de minimis privilege worldwide, which currently allows shipments under $800 to enter the U.S. duty-free. This section also increases penalties for violators of Section 321 of the Tariff Act of 1930. If I understand that correctly, it basically means that you still have to pay taxes if you are importing something under $800, which you did not before. But let's just see what ChatGPT says. Right now, if you order something from another country, like clothes, electronics, or random stuff from the online store, if it costs less than $800, you don't pay any import tax or duties. This rule is called the de minimis exemption, right? In the new rule, the U.S. is getting rid of that $800 duty-free rule totally for all countries. So now, every package, no matter how small or cheap, may face import taxes or duties. The rule also increases penalties for companies or shippers who try to cheat the system, like breaking up large orders to stay under $800. So supposedly U.S. manufacturers and retailers benefit the most, right? Because they compete more fairly with cheap foreign goods that used to sneak by tax-free. Customs and Border Protection, easier to enforce trade laws and stop tax evasion for sketchy imports, because now they just tax everything. There's not like a if it meets a certain dollar amount requirement. And the federal government will collect more revenue from these import duties. So consumers who buy cheap stuff from overseas, things you used to buy duty-free under $800 may now be more expensive. Yeah, that might happen. Again, we knew that that was going to happen as part of these tariffs and things like that, because we know that Donald Trump is trying to bring more business back to the United States. Obviously, there's no import fee, duty, or tax if you are buying something that is manufactured in the United States. Their business model relies on de minimis rule. Now they'll face higher costs. Right, so foreign e-commerce sellers like Shein, Temu, that rely on like not having to pay taxes because everything is so cheap, they're going to have to pay taxes now. Again, while some people may think that getting cheap clothes is a benefit, the fact that those prices go up is really probably for the best, right? And small businesses that import parts might see higher costs on small, frequent shipments from abroad. So if you're a small business that imports a lot of things, you're probably going to want to look for a domestic manufacturer to get those parts. So winners are U.S. businesses and government. Losers are online shoppers and cheap foreign sellers. It's asking me if I want a before and after cost example. Yeah. So before, Bluetooth speaker, $50. Final cost to you was $50. Yeah, right. I don't think that that's an accurate example. So now it'll be $57 instead of $50. So like, the price bumps kill the super cheap appeal. But, you know, those clothes suck anyway. How many of you have ordered something from Shein or Shine? However, first of all, tell me if you pronounce it Sheen or Shine. Then tell me if you've ever ordered something from it. And then tell me if you were really satisfied by what you ordered. Because I can tell you, the couple of pieces of clothes that I've bought from Shein were totally fucked up in one way or another. They were either stitched incorrectly or, you know, fell apart after a short amount of time. All right, this is going to be the last one. This is the last one for today. Section 112031. 032, limitation on drawback of taxes paid with respect to substituted merchandise. Under the current law, importers can claim a refund of excise taxes on imported tobacco products upon exportation of substitutable goods, even if excise tax was never paid on those substitutable goods. This provision limits the drawback of excise tax for tobacco products to scenarios in which excise tax has been paid on the exported goods that are used as the basis for the drawback claim. You know, I thought I was understanding it until that last part. So let's say a company imports tobacco products like cigars or loose tobacco into the U.S. and pays an excise tax on them. Right now, if that company exports similar tobacco products later, it can get a refund of the excise tax it paid, even if those exported goods are substitutes and weren't taxed in the first place. Basically, we paid tax on some stuff and now we're exporting similar stuff, so give us a refund, even if the exported goods were never taxed. Under the new rule, you can't get a tax refund unless the actual product you're exporting had excise tax paid on it. So no more loophole where companies use untaxed goods as the basis for a refund. Who benefits the most is the IRS. Obviously, they're making more money. They're closing a refund loophole. And fair playing tobacco importers and exporters. So level playing field, no more competing with companies that are exploiting the system. Who loses the most are tobacco companies that are using this loophole. They can no longer get refunds on untaxed imports. And large-scale import-export businesses lose a cost-saving trick that helped boost their profits. Those are large-scale import-export businesses such as Marlboro. Actually, Marlboro might be a U.S. company. Before you get a tax refund for exporting untaxed tobacco substitutes, now only taxed tobacco products qualify you for a refund. The winners are the IRS and tax fairness. The losers are only companies that used the old rule to get money back on untaxed goods. It was a loophole. This is just closing a loophole, and that's where we're going to close today's episode. Tomorrow we will be starting part 2, removing taxpayer benefit for illegal immigrants. Boy, I think that's going to be, we're going to have some people feeling different ways about that part. But that is tomorrow. So, thanks for joining me today. Make sure that you like the video, subscribe on Instagram, TikTok, YouTube, and of course Substack, theforkandnews.substack.com. Thank you for joining me. We'll be doing this again tomorrow and the day after until I'm done with the 50-page version of the bill. And then I will be comparing the 50-page version of the bill to the 1,000-page version of the bill. So, thanks everybody. Appreciate you giving a shit, and I'll see you later.